Hi, everyone. Thank you for joining us today. Parsa Vahid is a president of Strandlife Financial Group, which is financial advising firm and also a group benefits broker in Southern California. Parsa started in his space in 2009 and since has grown his firm to 8 full-time team members with 3 offices, one in Los Angeles, 2 in Orange County. He has worked for Merrill Lynch on the finance side and also for a large European insurance company. So he'll be well versed in both areas and I'm sorry, he will be discussing group benefits today. Welcome, Parsa.
Thank you, everyone. Thank you for that introduction. My name is Parsa Vahid, president of Strandlife Financial Group. We are a Southern California-based financial advising and employee benefits firm. Today, I want to talk to the business owners here who are thinking of either implementing a new benefits program for your employees, or you may already have a benefits program and just want to learn a little bit more about why you may want to re-examine your current plan. As I walk through the slides, if you have any questions, go ahead and write them down and we'll hold a Q&A session at the very end. And I'll stick around for as long as you need and we'll make sure to have all your questions answered, I should say. So first, let's talk about the different types of employee benefits there are. Now, most people, when they hear employee benefits, they just automatically assume a 401k or health insurance. And most of the time, that's exactly right. Retirement plans and group health insurance are the most common types of employee benefits. But there are also benefits designed exclusively for highly compensated employees or key executives. Next, I want to discuss some of the challenges many people are dealing with, specifically in the California market. And I want to talk a little bit about how to mitigate those challenges by setting up an employer plan. This is a way for employers to pay for their employees' individual plans as opposed to setting up a group plan. So for example, if an employee really loves their individual plan and just doesn't want to have to select from the choices within the group plan, we'll discuss how an employer can pay for the employees' individual plans, and we'll discuss that later on. Also, I want to discuss how choosing a good benefits broker like Strandlife can simplify the process of selecting and implementing a group plan, and also having a fully encompassed one-stop shop like Strandlife Financial Group, which is not only securities licensed and is well versed on the finance side of things. We also have life and health licenses and also commercial insurance licenses. So we would be able to cover workers' comp and general liability, and the benefits of having a group that handles all 3 avenues. There are a lot of moving parts when putting together employee health benefits for your employees, like selecting a plan design, how much should I contribute, which carrier should we offer, how do we educate our employees, what are the ERISA laws, so on and so forth. There's a lot that goes into the decision-making process, and a good broker will really not only help you set the plan up and provide services to your employees, but really take the stress and burden off your plate as a business owner to worry about these things. You already, just like I do, have so much going on within the day-to-day operations of just running your business. A good benefits company will really alleviate the stress and time requirements from the business owners above all else. Now, I want to talk about the health insurance market and just quickly review some of the basic terms. I don't expect most people to know because they're not in the insurance space day to day as I am. So let's just quickly outline them. First type of plan is the individual plan, or if you have a family, it could be known as a family plan. It would be considered a family plan if you have, your spouse or your dependents on there. And these are insurance policies purchased directly from a carrier. And by carrier, I'm referring to the actual insurance company that is offering the policy to the consumer. So these would include your Kaisers, Anthem, Blue Shield, HealthNet, United Healthcare, and there's quite a few more as well. This is more geared towards the California market. I know that we have many people spread throughout the United States, but Covered California is the exchange that the state of California, under the Affordable Care Act, set up to make selecting these coverages a little easier. Now, just as an aside, when this was rolled out in 2015, and I was kind of part of the first wave of licensed agents who had to become affiliated with Covered California, it was a complete disaster. The state government was not ready for it. The general public had no idea what the actual laws were. It was just a horrible setup. It had a really bad reputation. But here we are 5 years later in 2020, and I have to say they really have gotten their act together. In fact, this past weekend, I was at another conference for the National Association of Health Underwriters, and a rep from Covered California was there, and he and I spoke for quite a long time about just how far the state has come from the early dark days, as I like to call it. So Covered California is not only for individuals, but also for small business owners. The main benefit of the state-run exchanges are the federal subsidies. So for lower income earners, they do get the subsidy on the premium that they would potentially pay in. Next, we have employer-sponsored plans. So this is when an employer decides they want to begin offering group health coverage to their employees and begin to subsidize the cost for them. This falls into two categories: small or large group. Now, small group is categorized as any group from 2 to 100 employees, and a large group is 101 plus employees. Now, I can't talk about group health insurance without discussing the good old Affordable Care Act. Most people refer to it as ACA. Based on this law that was enacted in, I believe, 2010, it was enforced in 2015. The law states that you have to offer health coverage as an employer if you have more than 50 full-time employees. Now, I want to emphasize this next point as much as possible because, believe it or not, there are employers who have 50 plus employees and just choose not to abide by this law, and they can potentially be in a massive financial penalty situation, and they may not even realize it. The penalties in 2020 for not offering a plan that is of what they like to call minimum value and quote unquote affordable, and we'll talk about those two terms, but the penalty is $2,750 per employee minus the first 30. So I'll let you do the math. If you do have employees of that size, odds are you are offering it, but if you're not, just be cognizant you're running yourself a big, massive risk. Also not commonly known, but in 2020, the individual mandate is back. If you don't have health insurance and you are an individual, you will likely pay the fee when you go to file your returns this year again. So this goes back to just not having a good broker that stays up to date with these laws that literally are changing from year to year. It's vitally important. All right, moving on. I want to talk about the benefits themselves, and there are a few different types of employee benefits that are commonly known and some that are not well known at all, but are great benefits to help recruit and retain employees. The common ones that we often think about are medical. Excuse me, and we have subcategories which are strategies for employees or employers to maximize the tax benefits. The first one you'll see is a FSA plan or a flexible spending account. This allows employees to contribute pre-tax dollars to pay for eligible healthcare expenses, such as out-of-pocket costs, deductibles, co-pays, co-insurance. Generally, you must use the funds within your FSA account within the plan year, or some employers, and again, this goes back to the broker and the employer kind of dictating these terms, but some employers may allow you to carry over up to $500 of unused funds in the FSA to the next plan year. Anything above that, you kind of, if you don't use it, you lose it. The other type of tax advantage plan is called a HSA or health savings account. And these have the same tax advantages as an FSA with just a few differences. both employees and employers can contribute to HSAs, but the employee owns them. The funds can be rolled over from year to year, and the rolled over funds do not count towards the individual's maximum contribution limit. There are also contribution limits, but I won't bore you with these numbers. If you have questions, feel free to reach out after and we can discuss which strategy would kind of work best for your specific case. The last one is kind of gaining a lot of traction. This is really important for the larger groups. And this is an HRA. It's a health reimbursement arrangement. It's not account, but an arrangement. Common misconception there. This is set up by an employer to help pay for medical expenses for its employees. It's based on Section 105 of the Internal Revenue Code, and it's a type of self-funded, tax-favored program that may be offered in conjunction with a health plan. Any type of an employer size can offer an HRA to its employees. And again, the funds contributed into the HRA account can be deducted just like a business expense. So tremendous tax benefits there. And I won't go into too much detail, but of course, we've got dental, we've got vision, we've got life insurance, disability insurance. And these are more often what are known as voluntary or ancillary plans. And this just means that an employer can offer them, but also the employer can make the employee pay for these costs. Just really depends on how you structure the plan. It's not a requirement for the employer to subsidize these costs to their employees. Oftentimes they do, sometimes they don't. The last employee benefit that I won't be discussing on this webinar because it's a whole nother hour, but it's geared towards key employees or highly compensated employees, and it's not subject to the ERISA guidelines. And this is known as non-qualified deferred compensation. Again, it's geared towards employers who have key executives and they want to attract or just retain once they're with the company. And what some of the key benefits of these plans are, along with just how to design them. This goes back to the earlier point I mentioned of having a solid company that can not only offer you employee benefits, but is also well-versed on the financial components as well and can create financial products that coincide with your insurance benefits to maximize your attractiveness as a company. That's something that really differentiates a normal broker from someone like us, and we really pride ourselves on that. Moving on. Now, I just want to quickly discuss the individual marketplace, even though I know this is a webinar on the topic of group insurance, but I think it's important to point out why small business owners who don't have group coverage now should absolutely be thinking of implementing a group plan because of the rise of individual healthcare costs. Originally, the ACA required that everyone have insurance coverage or you'd be subject to a penalty. And this was really important because it increased the pool size so that not only healthy people, but unhealthy people were all kind of part of this pool, and they were paying into the pot, and that was supposed to decrease the premiums. But unfortunately, the elimination of the individual mandate by the Trump administration meant that less healthy people were paying in, and the healthy people, many of them decided not to pay in. And so what that does is it increases the risk of the plan, which of course leads to higher premiums. I'm very confident if anyone is listening to this and had an individual plan or family plan back for the next, or I should say in the past few years, 2018, 2019, you probably, I won't even say probably, you definitely experienced some outrageous increases in your premiums, sometimes upwards of 40%. 40%, that's outrageous if you think about, what it takes to be a middle-class American and have to pay close to maybe 20% of your household income just to cover your family's insurance needs. Another reason for those hikes in premiums was that Anthem, which is one of the largest insurance providers, exited the individual marketplace back in 2017. And I believe, correct, don't hold me to this, but I believe Cigna did as well. They just literally said, we want no part of this risk pool, so we're out. What that did was dramatically increase the cost of health insurance for all other carriers. And now providers are pulling out contracts with individual carriers, I should say. So increases for those reasons. There was also a change to how ratings were calculated as it relates to families. It used to be that there was one rate for one family, but now that has changed and each individual member is rated. So again, if one family member joins the family plan, that means the entire family rate goes up. And lastly, there were some grandfathered plans. That means an old plan that were written before the ACA came around that maybe didn't have all the bells and whistles that a new ACA compliant plan had, and was more cost efficient. Well, those plans all expired in 2018, and so that also led to the rise of premiums. Generally, there are two options for group plans. The first is what I call QSERA, or Qualified Small Employer Health Reimbursement Arrangement. Quite a mouthful. We'll just use the word QSERA for sake of brevity. Let's just say that you have an employee that absolutely loves Kaiser and begs you not to leave them. And let's just say another employee with Blue Shield, another with HealthNet. You can set up a QSERA. It's going to require some plan documentation and a TPA or a third-party administrator. But from a PR perspective, you're seen as kind of the greatest boss ever by allowing them to keep their coverage and receive compensation to pay for their individual plans. There is an admin fee for setting this up. It's not free, but generally less expensive than a group health plan. Also, just a side note, if you have a QSERA, you can't also have a group plan at the same time. So you can either set up a QSERA or a group plan. Having been in this business for so long, very few people offer QSERAs. It's kind of just for a niche kind of employer base who, again, they just have the employee who you just don't want to disrupt their coverage, and they're begging you to kind of stick to what they have. That's a QSERA for you. Moving on, I want to discuss group health insurance. That's the main reason why we're here. The main benefit of group coverage versus individual coverage is that generally group coverage is more stable than in the individual market. As I mentioned before, carriers like Anthem and Cigna dropped out of the individual marketplace, but those carriers are still in the group marketplace. So the rate increases are much, much more stable. Also, there are many more plan designs and more options generally when you have a group plan. So you have more HMOs, you have more options for deductibles, you have PPO networks, EPO, so on and so forth. So generally at the group level, there's just more options and more plan design. And also, not only more carrier participation, as I mentioned in the Anthem Cigna example, but also it seems that providers are more friendly towards group plans, and there's less confusion at the time of service. All right. Now, let's just assume you've decided to offer coverage to your employees. You want to know what type of coverage and why. So a good broker will really understand your company's needs. A young tech company with a healthy, vibrant workforce is much, much different than a mid-age female population, let's say, that has maybe quite a few potential pregnancies. So knowing your employee demographics is crucial to picking and offering the right plan for that workforce. So next, we must decide which carriers to offer, and this can really be dependent upon the geography of your business, not only the demographics. So generally speaking, Kaiser is a fantastic option if the workforce resides close to a Kaiser facility. But if you're out on the outskirts of a city, let's say LA, for example, you want to make sure that you're providing a Kaiser only if it makes sense. If there's no nearby Kaiser facilities, it may not be a good idea to offer that. So again, something that I think should be the homework of the broker to really do some research before they go through the carrier options. That leads to the provider check, which is another component. We have the ability, and many times have, checked with providers or doctors to ensure that if you want to make sure you have a doctor that's within the network and that accepts the new insurance, we'll implement that plan into the plan design. So the preliminary process can be quite cumbersome, but it's worth it. Designing a plan can really be where most of the time is dedicated. Because just like I mentioned, there's just so many options: copay, deductible, at max out of pocket. We want to make sure we're offering multiple plans that fit your employee demographic needs. Choosing how much to contribute to the plan to make sure that it's affordable for the business, but also that it's affordable for the employees. And again, there are rules and regulations that dictate what the affordability factor is. So again, if you have any questions on those, let me know. Lastly, there are sometimes some special programs that carriers will offer to incentivize people onto their plan. For example, carriers will sometimes say, we're offering a 5% discount if you bundle your health and dental insurance with us. Or sometimes carriers will have a minimum of a 70% participation rate to qualify, but now we're reducing it to 50%. So staying on top of the ever-changing programs is, again, a key component to our agency and any good broker that you're working with. Lastly, there is a way for you as an employer to offer multiple carrier options to your small group. So you're not just limited to one. For example, if you want to offer Kaiser and Blue Shield to your employees, you can have those options set up and offered just to kind of give your employees more options to choose from. So now you're asking yourself, what is needed to set up the group plan? Well, first thing you absolutely have to have is at least one W-2 employee, and you'll need to show at least 6 weeks of payroll. Without this, underwriting just frankly will not accept your application. Next, you'll need some sort of proof for full-time employment status, and that can usually be proven by offering what we call DE9Cs or quarterly wage reports, or just showing payroll records. Just in my experience, most carriers do require the DE9Cs. I have seen them without them, but those can be easily gathered from your payroll company. The employer will define the eligibility of the plan, and eligibility usually refers to you have to be working here for at least 30 hours a week. You can also dictate when they become benefits eligible. It can be as short as the first of the month following 30 days of employment, or if you want to extend that, you can go for as long as the first of the month following 60 days of employment, but you cannot go any longer than that. The minimum contribution usually is set to 50%. It can be 50% of the lowest cost option within the plan. And you also must meet affordability requirements. Again, I said I would touch on this. Those can be no greater than 9.6% of the employee's pay. So as long as that contribution amount that you give of 50% or whatever the dollar amount is above 9.6%, you'll be fine. And it almost always is. You can have buy-up options. So maybe you offer a low-cost HMO option for your lower income earning demographics, but for the executives, you want them to be able to buy up to a richer plan. You can do so and just have them pay the difference out of their own pocket. Or, you can just do 50% across the board. It really depends. It's fully customizable. You have to make sure that you meet the minimum participation requirements. I just mentioned that in the last slide. And they can be anywhere from 25 to 75% of the employees must be enrolled unless they have a valid waiver. And that can be a waiver for a plethora of reasons. Maybe they have great coverage on their spouse's plan. They don't want to leave that plan, or they just have Medi-Cal or whatever. Whatever the case may be, they must sign that waiver and show you proof so that they don't count against the participation. Next up is non-discrimination. We alluded to this earlier in the presentation, but you can't show any what I like to call favoritism because of the ERISA laws. It's just the same on the 401k and the retirement planning side. It's governed by ERISA. So if you're offering coverage to one employee, you have to be offering it to all your employees. Now, let's quickly just talk about the process that goes into enrolling in benefits. Let's say you watch this webinar and you decide, okay, I'm ready to offer benefits to my employees. How is this going to work? First, the broker would receive a census from the group, which would include basic information like names, dates of birth, zip code, and often salary information. We want to learn as much about the group as possible. So, if you're not already affiliated with that broker, have a good broker, you want to spend some time and just have the broker learn about your company, the people within your organization. So the census that we get, we submit that to the carriers, and then we get quotes back. Once we have the quotes, we can sit down and walk you through the quotes, review it. Definitely, we're going to go back and forth. Usually, almost always, the first quote that we present is never the final quote. So again, just kind of things that differentiate a good versus a mediocre broker. And then once you have the quote finalized, you're going to fill out an application. It's usually just a couple pages from the employer perspective. And then here's where technology comes into play. It used to be, just up until a few years ago, there was a lot of paper applications. Everything took a lot longer. We've invested a ton of time and capital into having the most up-to-date technology. So literally there's no paper anymore. Everything is done within the employee's email. We do enrollment meetings. They get the email. It has all their benefits laid out for them. It shows them what it's going to cost per their pay period, whether they're paid monthly, biweekly, whatever. It'll break everything down. If they want to add a dependent, if they want to dissect all the benefits, everything is done online. And that platform that we use is EASE, EASE. And then once the employee fills out their benefit selection form from their email, they would get their electronic cards immediately. So that's a huge benefit. The physical cards usually are mailed just a week or two later. But then voila, you've officially offered employee benefits to your employees. This generally, I shouldn't even say generally, always makes you more attractive as a company. It helps you retain your current workforce. I just recently, believe it or not, I do sell benefits, but I was just at that stage where it was kind of trying to figure out if we need to offer employee benefits. I've got 8 team members. You'll see them in the next coming slide, but we just offered them employee benefits, and I can't tell you what it's done for my business. It just kind of creates a sense of pride within your workforce as well. We've got benefits. It gives them a different type of feel. So these are just kind of some of the things that I wanted to mention. Now, if you're planning on offering benefits to your employees, you want them to understand the value. You want them to be properly educated on the plans, and you want the enrollment process as well as the ongoing assistance to be done properly. Excuse me. You want to make sure that payroll deductions are done properly. Usually we integrate our technology directly with your payroll provider so that the deductions are exact to the cent, takes all the legwork away from you, and there's just no guesswork. But maybe you do your payroll through your QuickBooks, or if you do payroll yourself, we'll help you with that as well. We want to make sure that you're deducting the correct amounts from your employees' pay checks per pay period. And then you are required as the group to pay the premiums directly to the carriers each month. You want to also make sure that you're abiding by the proper premium conversion plans for payroll tax benefits, so that the contributions that you make are not subject to payroll taxes. There are benefits on that side of things as well. And then lastly, excuse me, lastly, we just want to make sure that you have a system in place for new hires and also for terminated employees. Terminated employees usually go on what is called COBRA. So if someone just gets hired and they pass their waiting period, again, whether it's 30, 60, 89 days, whatever, you'd have a system in place to enroll them in their benefits, whether it's a packet of information that we would prepare for you, or just the website for them to log into and enroll. And on the other side of things, if an employee is terminated, making sure their termination paperwork includes the ability to enroll in COBRA, and so on and so forth. So finally, I just wanted to discuss the importance again. I think this is crucial. I'm sure I've highlighted it quite a bit, but the importance of having the rights benefits broker on your side. Generally, if you're going to offer group health insurance, you want to offer a retirement plan to go alongside it, and that's really my area of expertise. So I'll usually select the investments and work with the provider, whether it's Vanguard, Fidelity, American funds. We're completely agnostic. We usually go for the best investments at the lowest price, and making sure that we're taking all off the liability for you as the plan fiduciary, so that if things go haywire, I'm sure we've all noticed the markets are down dramatically this past week. If you sign off on that as the plan sponsor, you are technically liable and your personal assets are liable. Many people don't know this, but we remove that liability off of your plate. I personally oversee all aspects of the company's operations, from our 401k plans to our group insurance plans, and also our commercial insurance. So we've got expertise to handle all your needs. Each one of my team members has at least 5 years experience in their respective discipline. And so there's really never an answer that we don't have or we can't get for you within an hour or so. We're here to help. Please don't hesitate to reach out. And that's it. Woohoo! We finally made it. Thank you, everyone, for your time today. I hope this information was helpful and answered some of your questions. But I'm here. If you have any questions now, I'll open it up to some Q&A. So fire away.